Hey, good morning, everyone. Marty Mazzori here, October 28, 2019, Monday morning, hour and a half into the market session. And per our daily S&P 500 chart here, we are now at all-time highs. So if we close above that, we will have a closing all-time high. If you've been with me the last few weeks, either here on the video or on the written blog or both, you know that we've been calling for a marginal all-time high or a new all-time high, whether it's marginal or not, of course, remains to be seen. That's what we've been getting of late. This is consistent with what we're seeing on the near-term technicals, and it's also consistent with what I'm seeing just kind of out there in terms of sentiment, in terms of the potential. This is a huge week in terms of the Fed meeting, the jobs number on Friday, and some real important economic data throughout the week that I want to talk about as well. So, the question, of course, is are we now off to the races, so to speak? Is this a breakout that's going to be sustainable and move, significantly and again, sustainably into new all-time high territory? Not my base case, at least not presently. Very open to the idea, open to all possibilities, in fact. But the longer term technicals and certainly the fundamentals do not support that, in my view. And maybe more importantly, under the surface, if and when the next, correction, bear market, recession comes, there are some risks that lie beneath that I think are extreme. And they really concentrate in the corporate debt market. Talked about that a lot over the last year or so. And so when we have a market that is uh, trading in a manner that this one is, looking again at a marginal new high, these have all failed over the last year or two. And then you have these below the surface issues, and then you have a macro general conditions, if you will, setup that is beginning to wane. I think prudent long-term investors begin to get cautious. In our case right now, because the jury is still out, for our clients, we've made the choice to hedge using options collars that are modified so that the market can't completely run away from us to the upside. Um, Really small accounts, children of clients, that sort of thing, where we can't put the options on. Where frankly, we're just cutting equity exposure now in those accounts. Also, you clients out there, just to give you a heads up, we are going to begin scaling into gold using GLD, the gold ETF. The plan is to start with 2% of portfolios and scale up to say 5 or 6% over time. We haven't made the first investment yet. I wanted to wait at a minimum until we get through this week's Fed meeting. I could see gold move notably on that news. It's actually trading down today as the market's trading higher. It makes some sense to me, although up until today, recently, we've actually had gold move in tandem higher with the stock market. One thing just to throw that in there that's interesting today is that the VIX, the volatility index, also has spiked higher today by about 2%. Now, we've seen that on some mornings only to see it roll over during the day, so that may happen. I just found it interesting that on such a nice gap and such a big move higher, that implied volatility in S&P options contracts actually jumped as well. And I want to show you a little bit of my own research on the VIX and what it's signaling now as well. So just to zoom out on this chart, just to take a look back, remember back in here, here's your correction in early 2018. MACD signal line here rolled over. We came up, made a marginal new high, but we had this negative divergence. Get my tool out here. We had this negative divergence in the MACD and a very strong one also in the relative strength index. Then we came through here and we had just a terrible fourth quarter of last year. This is generally the best time of the year from a seasonal perspective. A lot of people are talking about that because we're about to enter that. But of course, last year that didn't play out so well. Then right in here, we actually had a bullish divergence. I believe I was pointing to that in the in the videos, and I was pretty optimistic right in here. In fact, we didn't react to this at all. Our macro index was still nicely in the green, and therefore our commentary then and our advice was just to hold tight. This looks like a steep correction within the context of an ongoing expansion and bull market, and we should come out of that. Sure enough, we did. The problem is, as we reach this next new marginal high, technically speaking, is that we had these negative divergences. We didn't have it on the RSI, but we certainly had it on the MACD. Then we came up and made a nice new marginal high back here in July, but a real rolling over. Now we've got these divergences that are really extending. Here we are again, virtually almost, you can almost call it a high, but we again, even just more confirmation that the momentum is waning. Here we are today, folks, another new high, at least on an intraday basis. And as you can see, this is not going to come anywhere near blowing out these negative divergences. So technicians, who pay attention to these things, and these things are good indicators, particularly when you have upward sloping wedges to go with them, as we've seen back here and as I've shown you time and time again. So this is not a sell signal. This is just something that says there's a high probability that this ultimately rolls over and the market trades at substantially lower levels. Doesn't have to play out that way. Believe me, I will be the first one to tell you when these signals turn out to be false signals. It's just that right now, the long-term kind of bearish technical evidence is intact. If this were something one would trade, you'd wait for a breakout below this wedge. This is not a sell signal. This is a trend signal, and it doesn't look very good currently. So technically speaking, well, it's nice to see these marginal new highs. The way we've hedged portfolios, we do capture the first leg of a higher high from the point where we hedged a portfolio. And then we're going to flatten out for a while. And then if the market really screams higher, then we're going to catch more later. And that's just kind of the structure of the hedge. Our concern right now, though, is in light of much more than just these technicals, folks. Our concern is something really big and ugly to the downside. And as long as things kind of square up the way they do on the longer term charts and on the fundamentals, we're going to stay guarded and we're going to miss out on the party if this does continue to go higher. If indeed, if these things resolve, fundamentals look better, good resolutions on international trade as one example, then of course, different story, and we'll do different things. The risk reward in our view up here does not allow us to go in and participate in this market, even like we were back in here, and certainly in here, and all the way, quite frankly, from the Great Recession when it bottomed in 2009. So long-term clients, this is unusual for us in the context of the last 10 years or so. But we're quite confident, not necessarily that the market's going to come crashing down, but that we are doing the right thing on behalf of protecting client portfolios. And we could be disappointed. This thing could melt up and we could extend, for years into what is already the longest bull market and expansion in history. It's just that right now, odds do not favor that. Okay, so I want to pull in two or three other charts that I track and pay attention to kind of give me a feel for near-term probabilities. This one I introduced to you back here in July. And before the market rolled over here, I was pointing to this yellow line here. It's the 10-day moving average for the daily volume of the S&P 500. And I drew the line in here at 500 million shares. And you can see as we came down and we had a little space while the market was rallying, what this means is volume was waning. And so you can call it lack of conviction. You might say the institutional money is sitting out. And that's just not a supportive signal for the rally and for this marginal new high. And sure enough, you can see what happened. As the market fell apart, volume picked up. So there was definitely more conviction on the downside. You see it happened here right before this top. You see it happened and was happening in here right before this big top. And even back here in early 2018, it was happening here as well. And then fast forward to today, folks, and you can see volume has just absolutely been falling off a cliff. So this is the worst look, frankly, at this new high of all the looks over the last couple of years. So that clearly says that the big money is not at all participating in this. Doesn't mean they won't come rushing in. In fact, this morning we're actually having above average volume. And of course, I can tell you that that's all the covering of those shorts who are sitting just above this all-time high. Whether or not that means we're going to go screaming higher with all that short covering, well, that demands a lot of money also adding and helping out that scenario. Unfortunately, what I suspect is it's probably sucking in the retail investor who's been kind of afraid of this market, and that's what happens during the late stages of a bull market, and they call it a bull trap. But of course, all that remains to be seen. So, of course, I'll continue to update you as we move forward. The this VIX indicator is something I just kind of stumbled onto as I score our index every single week. The green line is the spot VIX. It tracks implied volatility on at-the-money S&P index options, and then the 1 to 6 months futures on the VIX. So you notice here, right before these tops, we had some width, either between the spot and the first month and then the out months, or even the spot and the first month, but the out month. So what this suggests is that options traders and options moneymakers are pricing in substantially more volatility a month, in this case, 2, 3, 4, 5, and 6 months out, than they're pricing in right now. Again, notice this space that was occurring before this top, building during this real choppy period, and then before this huge top back here last year. And then just a lot of space, developing off and on in here. This one's a bit more ambiguous before the sell-off, the 10 to 11% correction in 2018. Again, folks, if you go back and you read our blog back here, I was just pointing to good fundamentals, a good macro setup, good backdrop for stocks, and telling you this was volatility to ignore. Same thing even during this deep one. Getting concerned in here and then basically calling it quits in terms of, okay, after 10 years, we're not going to just nakedly participate in this rally. I do have a scenario that says this continues and we go out further. It's kind of the scenario I had back in here, but that story is beginning to fail me in terms of the fundamentals, in terms of conditions, in terms of geopolitics and all those things that are important. So again, I know I'm being redundant, but not a party we want to attend, in my view, right now under the circumstances. Let me give you another one that I looked at just this weekend. This is the XLY. Actually, we use this ETF. It's the ETF that tracks consumer discretionary stocks, or the S&P index that tracks those stocks. Notice back here, 2018. Notice back here, this was beginning to top and roll over before the market rolled over. Notice that that ETF top, the discretionary stocks. And remember, this is where people spend their extra money on non-essentials. You see it rolled over before the S&P rolled over. It rolled over before the S&P rolled over here in July, rolled over before August. Look what's happening in here right now, coming up a bit today, of course. But again, and you had choppiness even as it was rolling over. So that's just another sign that says, boy, be careful in here. This is just looking like yet another failed top. I'll say it over and over again. Doesn't have to turn out that way. It's just not looking real inspiring to me, frankly. Okay, I'll just wrap it up here with a few additional points that I want to make. So this is a chart I grabbed yesterday. Interest expense highest since the financial crisis. So S&P 500 companies, what they are spending in terms of interest on debt, keep in mind, folks, interest rates are remarkably low. So what does that mean? They have piled on the debt like there is no tomorrow. I keep reminding you of that. And by the way, a ton of it is in the lower credits, lower quality debt. At some point in the future, either the near-term future or a little further out, we are going to be having a discussion, I assure you, of the utter mess and the fracturing that's going on in the corporate debt market, and that is not going to bode well for the stock market either. So this is just a real ugly sign. You can see it's the worst it's been since the Great Recession, and historically, it's about as bad as it gets. You can see back here in 2000, and what was this? That was another bear market, right? And then this one, and here we are pushing in that direction. Here's another look, investment grade debt, cash to debt ratio. Here we are. So folks, cash relative to debt they have on the books, frankly, is even worse since the Great Recession. So we're getting down here to the tech bubble bursting period. But this, again, another ominous signal about what happens under the surface when ultimately this economy rolls over. And it's not an if, of course, recessions are always a when. It's just that's the question, when. So I've heard the argument of late. There's tons of cash on the sidelines. Money markets are bulging. I agree. I've made that case many times myself in the past. Problem is when you have general conditions is concerning under the surface as I see them. This is more part and parcel to what happens when things are about to get real ugly. And as this says, their flows are surging into money market accounts despite falling interest rates, just like in 2007 and 2008. Again, another signal that does not make us feel good about our prospects going forward. For last night, I began making the latest entry into our internal market log. And I'll just kind of show you what I was writing. As we enter a seasonally bullish stretch for equities, the prevailing buy any positive new bias is painting an improving technical picture on a daily, weekly, and even monthly time frames. All three are showing bullish MACD crossovers and so on and so forth. So for just for our internal purposes, pointing to some things, and we'll cover this in our next investment committee meeting. But a lot of times I'll share this with you folks as well. However, the MACD and RSI slopes are still showing those negative divergences, and that's what I pointed to, and it's showing it on every major time frame. So nothing about those shorter term looks is helping me feel better about the longer term prospects. As for general conditions, manufacturing soft data, the surveys actually have been improving of late, making this Friday's ISM manufacturing survey for October a bit of a wild card. The consensus has it showing a third consecutive month of contraction, and that would get people upset probably. But I'm not so sure. The latest related releases, I think we could see an upside surprise, and that might bring hope to the market. Friday's jobs number is likely to come in weak, although the GM strike will be the culprit. So anything around 100,000, a little below even, with the GM caveat, shouldn't freak anybody out. And then between now and then, there is just a ton of stuff that comes out. This week's lineup: international trade, Chicago Fed National Activity Index, and so on. And also, and hugely, the Fed's next policy meeting is this Tuesday and Wednesday. Futures are pricing in a 90% chance of a quarter point rate cut. Again, I see a good chance that stocks trade higher in the near term. The market faces somewhat of a double-edged sword setup. Should, as some economists expect, the headline data begin to improve, traders will fret over the Fed becoming therefore less accommodative. Should, on the other hand, the data sour even more rapidly, traders will fret that the Fed is behind the curve and thus won't be able to skirt a near-term recession. The best near-term scenario for the market would be one where the data continue to trend negatively, believe it or not, but less so than in previous months, i.e., still justifying Fed dovishness, but not in dramatic fashion and not saying we're about ready to fall off a cliff. So for this market to continue to move higher against all of these headwinds, crazily, we need to see a continuing weakening economy, and the traders still need to believe that the Fed can save the day. Beneath the headline data, ominous developments are forming in the debt markets, as I keep pounding on. In particular, in a nutshell, amid dozens of concerning indicators of developments, the fact that corporate debt as a percent of GDP, and that's where I stopped, is just soaring, and all the other things that I talk about are things to get concerned of. So I'll clean that up and finish it up over the next few days, and I may share some or all of it with you. As for this morning's indicators, we had the Chicago Fed National Activity Index. Unfortunately, it showed a negative 0.45 and three-month average. Industrial production once again pulled the index sharply lower, this time for September, and so on. So not a good look there. And then international trade in goods. Now, trade deficit came in below expectations, so some people will say that's a good thing. Unfortunately, folks, it wasn't a good report. Notice that exports were down 1.6% and imports were down 2.3%. That is not a good signal for the state of the economy, make no mistake. And then lastly, another big report today was the Dallas Fed Manufacturing Survey. Again, it's these surveys that are telling me that the ISM this week might turn out a little better, although the Dallas survey wasn't so good. Other measures of manufacturing activity also suggest a slower expansion in October and demand decline. New order index turned negative for the first time in 3 years, falling to a minus 4.2. That doesn't sound good at all. The growth rate of the orders index also fell into negative territory. Cap utilization index retreated from 12 to 3.6. That's a 3 year low. Shipments fell 9 points. Wow, just not good for the Dallas region manufacturing survey. Broad business conditions were mixed, at least perceptions. The general business activity index fell 1.5 to a negative 5.1, negative after 2 months of positive readings. Company outlook continued to increase, however, itching up to 8.8. Um, Other bullet points. Raw materials prices uh, index ticked up to 22.8. That's a 10-month high. So they say we don't have any inflation. Well, certainly seeing it in raw materials. Finished good prices index pushed up to 4.8, which after being around zero for 5 months. Wages and benefits moved up 5 points to 22.2. So, folks, here we have business declining and costs going up. That's just late cycle, ugly sounding stuff. However, expectations regarding future business were more optimistic in October. It returned to positive territory. The index of future company outlook rose 13 points, highest level in 6 months. I think people think that the trade war is going to come to an end, and they're feeling somewhat optimistic about that. Well, I hope they're right, and I hope it happens enough to turn around this other stuff that we're seeing really across the board and has us concerned. And again, folks, I'll say it one more time. This stuff morphs into the economy rolling over. Those fractures in the corporate debt market, they crack open and we've got a mess on our hands. And I'm going to continue to remind you of that as long as we see these conditions. So, again, markets in rally mode today. It may be throughout the week and throughout the next few weeks. As long as conditions look like what they're looking like to me now, we have to sit tight and be patient and continue to be smart and careful in this environment. Thank you as always for watching and listening. Talk to you again very soon. Bye bye.